EVN recently reported nearly 52 trillion VND in profit for 2025, while sitting on more than 152 trillion VND in bank deposits. Is this a financial paradox, or is it a clear signal that Vietnam's electricity pricing is finally becoming more market-based? Welcome to this LIEMPT Core Investing Explainer. Today we're putting on our CFA analyst hats to objectively deconstruct these headlines and uncover the real structural trajectory of Vietnam's power sector. For an investor, separating the surface noise from structural reality is absolutely paramount. So we're tackling this headline head-on. A highly leveraged utility turning massive profits and hoarding cash might seem contradictory at first glance. But as we'll see, this might actually represent the dawn of a cost-reflective, market-based pricing era in Vietnam. To get to the bottom of this, we're going to move systematically. We'll start with the balance sheet realities and those hidden risks nobody's talking about, then transition into the massive structural policy reforms currently underway, and wrap up with an actionable equity investment playbook for your portfolio. Let's jump right into the financial paradox itself and decode exactly how EVN flipped a multi-year historical loss into a record 51.8 trillion VND profit. The core financial equation here reveals a fundamental shift. Revenue grew by an impressive 11.2%, largely driven by 4 flexible electricity pricing hikes. At the same time, cost growth was contained at just 3.4% as the massive global shocks in coal and gas prices finally started to cool off. So, the key takeaway here isn't just EVN's raw profit number. The real insight is that electricity pricing is finally starting to reflect real input costs. Revenue simply outpaced stabilizing fuel expenses, and that created a massive margin expansion. Now, what about that massive pile of cash? Let's unpack this liquidity buffer, because the truth about that 152 trillion VND is highly misunderstood.
The public sees 152 trillion dong sitting in bank deposits and immediately assumes it's just idle cash. But when you take an objective look at the holistic balance sheet, you see a staggering liability figure, 340 trillion dong. That is EVN's total debt and lease obligations. When you're managing a debt pile of that magnitude, your cash buffer isn't a luxury, it's a vital systemic safeguard. That deposit equates to barely 3 months of operational revenue.
Think about the daily reality of carrying that debt. Every single day, EVN faces around 45 to 46 billion VND just in interest expenses, and that's before accounting for their massive capital expenditure cycle for grid upgrades. For EVN, cash is not just an asset on a spreadsheet. Cash is the oxygen tank. It's the literal ability to keep the national power system running, ensuring timely payments to independent power producers and fuel suppliers.
However, as analysts, we can't just look at the rosy cash balances. We need to look beyond the income statement at the hidden risks hiding in plain sight.
To build a cautious, realistic picture of EVN's true financial health, we monitor these off-balance sheet dangers. The most glaring is the 17.5 trillion VND in foreign exchange exposure. Because EVN relies heavily on foreign currency loans, these unrecorded exchange rate losses are a critical, unresolved obligation. We also track suspended, unrecorded gas transit costs for the Pumi A and Kama A plants. Add in global fuel volatility and the ever-present risk of policy-driven limits on retail pricing, and you get a much more balanced view. Yes, the profit is real, but so are these pending systemic liabilities.
Having a stabilized financial foundation is crucial right now because it enables the massive structural shifts we are seeing as Vietnam transitions to a true market economy for power.
We are witnessing a highly coordinated institutional push. In February 2025, the revised law on electricity took effect. By March, Decree 57 officially formalized Direct Power Purchase Agreements, or DPPA. Looking ahead to 2026, we'll see the rollout of 2-part tariffs for large consumers, followed quickly by Circular 29, which lays the groundwork for a competitive wholesale electricity market. The grid is visibly moving away from administrative state control and toward a transparent, competitive framework. A prime example of this new market reality is the shift to 2-part tariffs. Under the old system, consumers just paid a flat rate for the energy consumed. Simple, but highly inefficient for the grid. The new 2-part tariff introduces a fixed capacity charge based on your maximum registered kilowatts, plus a variable energy charge. This fundamentally shifts industrial behavior. It forces large factories to optimize their load shaping and penalizes the inefficient peak-hour consumption that historically strained the entire network. And this isn't just economic theory. If you look at a factory consuming 200,000 kilowatt hours under the old tariff, their bill sits at around 440 million VND. Under the new tariff, if they manage their peak load effectively, their bill actually drops to 420 million VND. Efficient factories save money, and at the same time, they provide EVN with predictable fixed revenue to fund vital grid upgrades. It's an elegant win-win that incentivizes overall system stability.
So, what does this mean for your portfolio? Let's translate these macro improvements into an actionable investment playbook, focusing on how we capitalize on this unlocked liquidity.
Because EVN's liquidity is improving, delayed payments to power plants are naturally going to decline. We categorize the listed beneficiaries into a few distinct groups. You have upstream and grid contractors like PC1 and TV2 riding the transmission capex wave. You have LNG infrastructure monopolies like gas. Downstream, green generators like RE and HDG can now sell directly to corporations via DPPA. And finally, thermal and gas generators like POW, NT2, and PGV directly benefit from EVN's better payment cycles.
To break that down strategically, PC1 is a prime accumulation target to capture the massive $18.1 billion grid expansion, while GAS serves as your defensive cash-rich anchor. Further down the cycle, REE is perfectly positioned to capture the green energy premium under the new DPPA framework. And POW acts as a strong cyclical accumulation play as their massive Neon-Track 3 and 4 LNG projects come online.
To wrap up this explainer, let's consolidate everything we've discussed into rapid-fire executive checklists based on the LIEMPT core investing framework.
First, these are the 5 key terms you need to master: DPPA, two-part tariff, liquidity buffer, BESS, which stands for Battery Energy Storage Systems, and FX risk. These aren't just industry buzzwords. They are the foundational vocabulary you need to truly understand Vietnam's evolving energy sector and its upcoming market re-rating.
Next, anchor your thesis in these 5 critical numbers. Yes, EVN has a 52 trillion VND profit backed by 152 trillion in deposits. But you have to balance that against the 340 trillion in debt, the 45 billion daily interest expense, and the 17.5 trillion in pending FX exposure. These numbers definitively prove our point. EVN's cash is a vital systemic safeguard, absolutely not an idle luxury.
Always track these 4 hidden risks: unrecorded FX losses, suspended gas transit costs, unfinished capex burdens, and those lingering policy-driven limits on retail pricing. Keeping these risks in focus ensures you maintain an objective, dispassionate perspective on the long-term bankability of the sector.
And for your portfolio, keep a close watch on these 5 listed companies: PC1, REE, POW, Gas, and NT2. With EVN's payment backlogs clearing and new market mechanisms coming online, these equities are directly in the path of improved sector cash flows.
Ultimately, EVN's profit is not only a monopoly story or a bank deposit story. The deeper, structural message here is that electricity pricing is finally becoming more cost-reflective. System liquidity is demonstrably improving, and Vietnam's power sector cash flow may actually be entering a much healthier, sustainable cycle.
I'll leave you with this final thought. Don't just read the headline. As pricing shifts from social containment to market reality, is your portfolio properly positioned for the power sector's next decade of growth? Follow LIEMPT to understand the real story behind electricity pricing, cash flow, and Vietnam's energy sector re-rating. Thank you for joining this explainer. Review your portfolios, track the catalysts, and as always, invest intelligently.